This is Mark Anthony with Mercury Time Price Analytics. Welcome to a very special report. We just released our weekly market report. It's titled Do It Again. You can find it on our website. It is the longest, most detailed report that I've ever produced. And the time is appropriate, I believe, to go into that level of detail because the market's got some very important decisions to make now that options expiration week is over. We're going to come back to this chart at the very end. You can find the written version of the report on our website, mercurysignals.com, mercurysignals.com. And if you click on market reports, that'll not only show you the most recent report, it's also an archive of all the reports that I posted this year. So here you go. Just click either on the image or click on the text below it. And after you get the annoying pop-up, you can read the written version. And that'll provide all the commentary. There's 16 charts in this week's report. Tremendous level of detail. It'll take you some time to read it, but I believe it's worth it because this truly is an extremely important market inflection point. So what I'm going to do on this video is just run you through the charts, and then afterwards I encourage you to take time to read that article for the full commentary, and it'll put these charts in even better depth and put them in perspective than I can do on a video. So without further ado, all right, you've got a couple important central bank meetings coming up. The 27th, I believe, you've got the Jackson Hole Conference. And what the Jackson Hole Conference is, it's when central bankers from around the world get together and ruminate on their collective wisdom, basically. Here's the problem. This is the LQD ETF, the BlackRock high-grade corporate ETF. This is not the junk bond ETF. This is high-grade. That should concern you, seeing this in high grade. So this is the chart at the end of last week, not the week that just finished, the week prior. And this chart was in our report a week ago. But I wanted to show you the LQD chart from week before last, and then we'll take a look at yesterday. So, I mean, you've got all kinds of breakdowns here. Now, let's show you at the end of yesterday. That doesn't look a whole lot better. In fact, looks to me like this is just consolidating before the next move down. Now, we'll see. I mean, the idea in trading is not to predict, but to wait till you've got some confirmational data. But this doesn't look good. And this is investment grade. This is not junk bond. So we started the week in a real tight range, and it doesn't matter what type of chart you look at. This particular chart shows a combination of our algo regression lines and then our key fixed algo price points, which we call Mercury bands. And so you can see this tight range between 33.59 and 33.79, and that's where we started the week. This 33.79 level was very important back in February, specifically on February 20th. Now, that's the day in February 2020 where you hit the all-time futures high, and then it just went to heck after that. So 33.79 is an important level. And then every time, and I mentioned this at the beginning of this past week to our members, anytime we get a break of this 59, it's going to get sloppy. And you'll see that on some of these charts. So this was the beginning of the week. That was Monday. Chart 4. You can see tight trading between the algo regression lines. Now, if you haven't watched any of our other videos, let me stop for a moment and explain what an algo regression line is. We often think of time as circular. You look at a clock, it's circular, goes round and round, same number of hours, minutes, and seconds every day. Here's the point. When you look at time algorithmically, time is both circular and linear. And what do I mean by linear? Well, time marches on. You can't stay in a point of stasis, and you can't go backward. So even though a clock is round and you've got the same number of hours, minutes, and seconds in every day, time itself is linear. And what these regression lines do is they show you graphically both the linear and the circular functions of time. Now, what do I mean by circular in terms of this chart? Well, notice how price continues to go back and forth between these regression lines. It's magnetized to them. Now, the linear part of time is that at some point, the market loses connection with the upper regression line, and then that regression line just marches off the chart into the stratosphere, never to be seen again. And so what you look for with these regression lines is what type of activity do you get when price loses the connection? Now, in a real strong market, you'll just see it come down and start interacting over and over with this lower regression line. That's not what we're seeing. We're seeing a failure to maintain the connection at the upper regression line, and that's okay. It's normal. At some point, price is going to lose its connection with the upper regression line, and then it's off the chart. But the problem is it's now starting to break the lower regression lines as well. So this was Wednesday, and this is where you started to get the break. So was that chart 3 or chart 4? That was chart 4. All right. This chart is NQ. Now, NQ pretty much, NQ futures, the equity index for the big tech stocks, NASDAQ 100, just marched on its merry way this week. Apple closed the week within a hair of 500. Can't believe it didn't do it when it got so close, but who cares? But here you see our algorithmic oscillators, and it's just, this is Friday the week before. This is Monday of the week that just passed, Monday the 17th. And this particular chart shows you Monday and Tuesday, and it just marches right on up. Now, occasionally you get these sharp, swift pullbacks, like you see there and there, but it collects itself and then moves right back up. So what you saw in NQ this week does not tell the story of how S&P is just breaking down to a tremendous extent. I mean, S&P 500 is just nothing but ugly right now. I understand that they closed the week at 3,400, but a large part of that could be due to the machinations of options expiration. The real deal is what happens after OPEX over the next week, 2 weeks, month, 2 months, because the extent of the technical damage that was done in the S&P on Wednesday the 19th, that was consequential. And you don't just get over that type of wound, metaphorically, and move on. The action that we saw on Wednesday the 19th in the S&P, that will have consequences, and it will manifest itself and reconcile itself over the next coming weeks. But that was the shot across the bow from the bond market, and that's why we started this looking at the bond market, because the Fed and other central bankers have painted themselves into a corner. But right now, particularly the Fed. Because, and I'll give you an example. You see all these folks on TV talking about, well, with all the liquidity that the Fed is providing in the market, any pullback in equities, should be brief, not a big deal. You've got all that liquidity. Here's the problem. The bond market is way, way, way bigger than stock markets. And that fountain of liquidity that the Fed provides, in the short term, it rains down easy money until the bond market says enough. And what you saw over the last 2 weeks, going back to the LQD chart, what you saw over the last 2 weeks is the bond market saying, that's enough, ring the bell for last call. And now what's happened is the central bankers, the Fed in particular, has to make a decision. You see, they can't save or prop up, whatever term you want to use. They can't prop up both the stock market and the bond market indefinitely. They can do both for a little while. But at some point, the Fed has to make a choice. And I'll let you in on a little hint. The bond market is way more important than the stock market. Does the Fed want to see the stock market go down? No. But they're at the point where they're going to have to make a choice. You can live with a pullback in the stock market, and the market needs a healthy correction anyway. But you can live with a pullback in the stock market. You got big problems if you let the bond market blow up. And the volatility we're seeing in the bond market is called the MOVE index. That's the volatility metric for the bond market. This is not good. All right, so let's move on. Which chart were we at? Okay, we showed you that one and that one. Okay, so this chart has a ton of horizontal algorithmic pivots on it. Now, this is not what the chart is supposed to look like. You see this kind of stuff after the market has went on a crazy extended bull run, because what you've got here, and this was Wednesday, and I told our members when we posted these algo levels, these horizontal lines, before the market opened, and I said, be careful, because this should be the day that you get a nasty probe lower. And here's why. There's about 12 key algorithmic pivot levels in the tight space between 3378 and 3390 on Wednesday. Now, under normal circumstances, you take these 12 pivot levels, they're about 100 handles apart. Now, some of them are 20, 30 handles apart, but you take all of these that are right here clustered in this 12 handle range, literally 12 algo pivots in a 12 handle range. I mean, some of these are 30, 40, 50 handles spacing between them. And if you take this cluster of algorithmic pivots as a whole, from top to bottom, you normally see about 100 handle range. And so when the market gets really extended and it gets really tired, these all start moving up and they cluster together. The best metaphor I can give you is when you were a kid, you and your friends ever try jumping over a high bar? Well, you set the bar low in the beginning, and it's pretty easy, and everybody jumps over it. And then as it gets higher and higher, you whittle down the number of folks that can jump over it, and then it gets to the point where there's maybe one person left who can jump over it. And to do so, they have to have their best, most explosive jump, plant their foot at just the right spot. Timing's got to be perfect. Well, what you see when you get these types of setups where all of these algos that should be really far apart, I mean, they should all be kind of like these two, okay, all the way down. But what you also get is you get the daily bull bear pivot, which is the most important metric we offer. You'll get the daily bull bear pivot way up at the very top of the range where the market opens that day. Well, on Wednesday, the daily bull bear pivot was 33.89. Now, that puts, and again, back to the high jump metaphor, you've now set the bar so high, and metaphorically, you can consider this daily bull bear pivot as that high bar. On that day, on Wednesday, the bulls had no margin for error. They had to take this thing higher directly off the close, get it over 3,400 and run, because the longer they messed around near the daily bull bear pivot, giving that you had this massive cluster of algorithms, all it would take is a little bit of a pullback. I mean, all you're talking about is 12 handles between here and here, and you start doing major damage. Now, where did it release? It released right here after you broke out of this cluster, and then you get this nasty move down. All right, now this is cool. We've got a video on YouTube about our Saturn GT40 algorithm. We finished this up a little over a week ago. And this is, without a doubt, the most advanced algorithm that I believe has ever been available for individual traders for the consumer market, because it's a predictive algorithm. What do I mean by predictive? Well, what you're looking at on this Saturn GT40, most specifically, is the purple algo and the two white algos. And what you're looking for is peaks of where the slope peaks, where the slope crests, and then you're also looking at spots where they cross through each other. Now here's where you get into the predictive part. You have this high right here. So what you do is you simply take a horizontal line at the peaks of the slope, the troughs, and at the points they cross over. So here you have this peak right here. Comes up, does a higher peak, and where does it start to break down? Directly at that vector, at that horizontal line, laid right on the top of the peak of this little slope. Now, where is, I thought of these notifications off. All right. That's the peak of the slope. Now, where is the trough? Right here. Well, take a line and draw that over. That's the next level that broke. See, it came down here, it tried to hold it, and then it breaks. Now, take this little trough here. Draw a horizontal line right where the bottom of the trough of that slope is. Where's the next level that broke? Right here. Oh, would you please? Hang on a minute, gang. All right, I'm not going to turn it off right now. We'll just deal with it. But you put another vector right there, and that's where it breaks. And you can do this all day long. And I'll just pick one eyeballing it real quick. Let's see. All right. Take where the purple crossed over the dashed white right there. And you take that across, and it's right here. So it came down, it tried to get over this level right here, and then you get the pop and drop. And I'll show you one more, but we got a whole video about this. Take this level where the white, the two white lines come together, the dashed white and the solid white. Draw a vector, a horizontal line. Where does it stop? Right here, literally to the tick. Comes back up, and when it comes down again and breaks it, you get the extension. So these peaks and troughs and crossovers are all over the chart, but to my knowledge, this is the first predictive algorithm that's been made commercially available, because what you're talking about here is not just a trading algorithm, but you're talking about third and fourth and fifth derivatives of trading algorithms, and this is the type of really high-end stuff that the institutions have. This is the kind of stuff the institutions use so they can look at where price was, not just looking at price, but looking at algorithms, where they were previously, and they extrapolate that forward, and they know. The algorithms know where to sell. They know where to have their stops, because they know if this breaks, it's going down. If this breaks, it's going down more. And if this breaks, you're going to get something nasty. And oh, by the way, when you get the retest right back up into this, well, then it's going to go again. But the institutions have predictive algorithms. To my knowledge, this is the first and only one that's available for individual traders. Now, you stop and think for a minute how many millions of dollars that the institutions spend developing these algorithms. And then go on our website and check what we charge for you to have the same thing. We've been advised by, we hired a consulting firm about a month ago, and they're still doing their analysis, but they came back to us and said, y'all are crazy for offering this for what? I mean, you're offering something that institutions pay millions of dollars for. Okay, well, the reason that we're not charging millions of dollars is we didn't develop this for institutions. We developed this for individual traders, folks like you and me, so that we could have the same advantage as the algorithms have. So, but I mean, bottom line is, whatever we charge for this, I mean, you're literally getting institutional level algorithms that they pay millions of dollars to develop. at a price that's a few handles a week. All right, so let's move on. We got a lot more to talk about, I believe. Yeah, that's the one we just did. All right, now here you can see on the 19th, this is the regression line to which S&P 500 had been connected to for the better part of a month, probably more than a month. Well, that one's gone. That's up into the stratosphere. Now you can see this one. And you can see how many times it's battled over it, up and down. I mean, you can trade just off these regression lines. But here's the problem that it's already losing connection to this. And we saw this week, and I'll show you this again, multiple failures and sharp moves lower. Well, it just lost connection with the regression line that it was entangled with, connected to for the last month and a half. And now it's just starting as of the last, say, 10 days, 8 to 10 days on trading days, not even, maybe 7 trading days. And in the first 7 trading days of being in connection with this this regression line, it already keeps losing it. That's not good. That tells you that the support underneath this market is starting to give way. All right, so that's the one we just looked at. And this is what you get. So this is Thursday the 20th. So you price couldn't maintain connection with that upper regression line that had been connected to for about 4 to 6 weeks. That one was about right like that. It's gone. And now you start interacting with this next one, and it can't even keep up with that. Now, what we saw a couple times last week is these spikes down and then the goofy spikes back up. Well, guess what, gang? That's options expiration week. The real proof in the pudding is going to be what happens going forward now that August 21st options expiration is over. All right, so now we're on this one. Now, I want to talk for a minute, and I got to watch my time because we're already over 20 minutes on this. So the question is, how do you trade these markets? Well, you trade it with algorithms. I don't know how, and I'll be completely frank with you. If I did not have access to algorithms on par, as good as what the institutions have, I wouldn't be trading this market. It's too dangerous. I don't know how anybody risks their money in this market without having algorithms. You got to be real careful and have really good risk management, or I mean, it's not good and it's difficult. So what you have on here, this is our automated algorithm, and this thing just absolutely crushed it this week. And not a day goes by that our automated long-short algorithm finds a trade. Not a day goes by that it fails to find a trade. And I just want to show you right here. This just isolates a couple of days, Wednesday and Thursday. And then I'm going to show you the full week chart for the automated algo. Now, the day just prior to this view of the chart, the automated algo for NQ got short at 11,406. And it came down here and it flipped long here at 11,273. So right off the bat, that's 133 handle move in NQ in a day. Now, if you're trading one lot of NQ, it's $20 a handle. Now, they got the micros out too, but it doesn't matter whether you're using the regular NQ or the micros. That's a big move, 133 handles in a day. Now, the way this works, the cyan line is our momentum algorithm. All right. When you get a strong move down, at some point, the momentum algo is going to start to level off. And then after it levels off for a time, either it's going to turn lower and start the next leg, or it's going to turn back higher. I mean, it can only do one of two things. All right. Either it's either going to turn up, turn down, or it's going to consolidate. And then like a fork in the road, it's going to decide whether it wants to go higher or lower. Now, each bar on this chart, you have 2 white dashes, and that's our proprietary volatility metric. This is the most important thing I'm going to share with you today. And to give you an idea how sincere we are at helping other traders, whether you're part of our service or not, I'm going to explain to you the most important thing to know about volatility. individual traders, human traders, perceive volatility differently than algorithms process volatility. Let me repeat that. Human traders perceive volatility much differently than algorithms process volatility. And it's all detailed. It's very, very detailed explanation in the written version of the article, which again you can find on the website. But the way our volatility metric works is the spacing between these two white hashes on each bar, or the lack of spacing, indicates what's happening with volatility. And here's the key. People think of volatility as a specific, let's just use the VIX. People think of volatility as a specific measurement at a specific time. No, that's not important. The only thing important in terms of trading with regard to volatility is the second derivative of volatility. If you understand that one thing, you will literally go from wherever you are in trading to literally like the top 1 or 0.2% of traders. And here's what I mean by second derivative of volatility. Volatility, oops, sorry. Didn't mean to drop that on the computer. What's the second derivative of volatility? It means volatility measured against itself over recent periods of time. Now, not just one period of time. You have to measure it over multiple recent periods of time. And you have to look at algorithmic time frames in those lookbacks. So here's what happens. As prices coming down, remember the automated algo got short the previous day at 11,406. So you get this really nice move down. And you can see over here where they come into the chart, really wide spacing. Now, notice how the spacing gets tighter and tighter. There's two of these on each bar. They get tighter and tighter and tighter. What happens when you get down here to the bottom? They start getting really tight. Now, the way this sequence works is the first thing that happens is the momentum algorithm needs to level off and then turn up. All right? But see what happens to the volatility metric? It gets down into here, and these two lines have completely merged in here. Now, when you get the change in the slope of momentum, in this case from down to sideways to up, all that does is it puts the algorithm into the ready state. It's not taking any trades just because the cyan momentum line turns up. That simply puts it into the ready state. The trade trigger is when the volatility has stopped expanding and the volatility gets as compressed as it possibly can, and then the trade entry is when it crosses from underneath to over and above. That's how the long triggers. A short trigger is just the opposite. Momentum's going up, it peaks, rolls over, and then you'll see the volatility dashes, which on the way down are on the left side. On the way up, they're above the momentum line. And after the momentum line turns over, then you'll see the same thing. The spacing in volatility, the compression in volatility will get really tight just as the point that it's about to cross over. And the short is the opposite, when the volatility dashes cross from above the momentum line to below. But here's the secret sauce. Volatility gets as compressed as it possibly can just before the trade triggers. Now, I want you to think about this for a minute, because mathematically it's very complex to do what you see on the screen. But just in terms of logic, it's super simple. There's two primary things you want to have in your favor in order to make your long entry or your short entry work. Number one, you want momentum to continue in the direction of your trade entry. So if you're long, you want momentum to continue trending higher. If you're short, you want it to trend lower. But in addition to getting the direction of momentum right at the point you enter a trade, what you also want is to get into the trade at the very moment that volatility is the most compressed as it can be relative to itself. And that's what you see here. And then what you want is right after you get in the trade, you want volatility to start expanding again. Now, how beautiful is that? The two white volatility dashes, the second derivative, volatility compared to itself, they're merged. 1, 2, 3, 4, 5. And the number of bars that they are completely merged gives you an idea how violent the move is going to be in the other direction. And so once you get into this trade, volatility starts to expand, and here it compresses right before the next leg. Now, the other part about the secret sauce here, remember I mentioned that human traders perceive volatility different than algorithms process volatility. The second part of the secret sauce here, and I don't care if institutional folks are watching this, if you can build a better algorithm, go for it. What they do has no effect on what we do. We're already several steps ahead of them, so it doesn't really matter. But one of the other parts of the secret sauce is that there's a very sophisticated formula in this, and it's related to the change, the second derivative of momentum, and the second derivative of volatility. Because what happens is when this algo triggers, you almost always see a bull trap or a bear trap. Now, if you're just getting long, you want that trap to be a bear trap, right? And that's what you see here. And what causes this, and again, this is really detailed in the written article. You really need to read it. This video is not a substitute for what's in that written report. But what causes bull traps and bear traps is this thing called recency bias. Recency bias is when something occurs and then shortly thereafter reoccurs and it looks the same that second time. Well, then we naturally think, well, it looks the same as what just happened, so therefore the result is going to be the same as what just happened. So what happens here is you get this spike up, and folks are thinking about what happened over here. Not to mention, you had this failed back test right here at the same price. So what happens? People who missed this short here all the way down, they short in the hole. Don't ever short in the hole. Doesn't work. And what happens is price comes down, you get your bear trap, and boom. Now, how do you know that this was a bear trap and not the beginning of the next move lower? Well, notice the vol dashes never crossed back down and through the momentum algo. Easy peasy. See, when we designed this thing, although the math is very, very sophisticated, we knew in the very beginning that this had to be easy to use graphically, or folks, we're going to misinterpret it and have a problem. So two things here show you that this is going to be a bear trap. One, the volatility metric never crossed back down through the momentum line, the cyan line. And number two, from this spot to this spot, look how the volatility gets tight again. See, this is what I meant when I said that humans perceive volatility different than computers process it. So this move up and down and up, that looks volatile, right? Well, not compared to the way volatility was an hour, 2 hours, 3 hours, 4 hours ago. This is just a fake out. And so it runs. And then folks do the same thing here. They look at this and they're like, oh, okay, it failed back here. Let's short this one. Well, price went down, but all the volatility did was compress, and it didn't go through the momentum line. And this is where the second and the third leg always start. You'll get volatility to compress, and in the case of a long entry like we have here, it'll just snug right down into the momentum line but not go through. Volatility is completely compressed, and then boom. And then you get the double whammy, because when you get this move from down here that goes back, you get a double bear trap. You get the folks that were short here, they get their stops run. And you get the folks that were short here, they get their stops run. and you get the late folks that shorted down here. I mean, this was nasty, but I guarantee you the institutional algos saw it coming. They read it the same way our algo did. There was no reason to get out of the long. Now, should you have tightened your stop or taken some partial profits when you start seeing this? Yeah, but there's no reason to close out the whole trade. You would definitely want to take a partial and lock in some profit, but there's no reason to get out of the trade. So let me show you. That was that one. Okay. All right, so here's the whole week, and I got to do this quickly because we're really running long here. So here's Monday. This is our NQ algo. We've got one for ES as well. So our automated NQ algo Monday of last week, which was what, the 17th, long trigger 11,155. The exit on the long trigger is up here at 11,418. Then you had a short trigger here at 11,406, and you had this move down, and starting about right here, that was what you saw in the previous screenshot, as it was a zoomed in version of this whole sequence. And then down here it gets long again. So I mean, just this short and this long, 133 handles down, and then from where it got long into the end of the day, 233 handles. I mean, is that nuts? And that doesn't even take into consideration this long here on Monday. So look, you cannot outtrade an algorithm. You can't. There may be some human traders who can outtrade an algo over a very short-term basis, but over anything more than very, very short term, the algo is going to crush a human trader every time. And that's why the institutional traders have replaced the majority of their human traders. I mean, 95% of the trading is now done by algorithms. So just a couple more slides now. While all that nonsense was going on in ES on the 19th and the 20th, where it was breaking down, well, NQ just trades purely mechanically, mathematically, algorithmically. You get it came down right here to just above this key intermediate cycle algo. Then it comes up here and it settles back, finding support right in this algo cluster here. And by the way, these Mercury bands, for NQ, we put these out before the week starts. So here you're looking at NQ action Wednesday and Thursday. These levels here that say Mercury bands, those are put out Sunday before trading even started for the week. So you use these in combination with one another. So where did this find support? Right here at a Mercury band. Where did it find support here? At a Mercury band. Came down here, forget about this algo for a minute. Where did it find support? Mercury band. And every one of these levels was calculated before trading started for the week. Now the Mercury bands for ES, we update those every night. NQ doesn't need to be updated unless it goes completely through the range at the top or the bottom. That's the only time we have to update these during the week. So just last couple of slides. Now this is where it gets scary for S&P 500. Very tight trading range between the regression lines, and now you're starting to get this stuff. All right. You had this Tuesday of last week. You had it Wednesday of this week. You had it Friday of this week. And the problem is, as I mentioned earlier, the connection to this regression line, that's only been for maybe 10, 12 trading days. I mean, it had just come up into this not too long ago. And now it can't even hold it. And now it's struggling to hold this blue one below it. That's not good. Now, we can also look at charts algorithmically using our algo oscillators, these wavy lines that go through. Now, this too shows you this thing's got problems. This is the last trading day in July. Price came down and got into this purple oscillator. Now, you've got two trend oscillators here, this orange one and this orange one. And then this is a little bit more of a longer term. But what do you see here? 2 tests down into trend oscillator number 1. Comes back up, can't extend above the previous high. Then you get a 3rd test of this orange trend oscillator, and a 4th, and a 5th. And then finally, you know, after typically the 5th one is the one that goes. So they had, you consider this all one test. 1, 2, 3, 4. And there's your 5th one, splat. Then it comes down into the purple one, down, up, down, up, down 3 times. Recovers the algo that it lost, and for how long? You know, it recovered that into the late afternoon on Thursday, and on Friday it did it again, right down into this purple line. Now you come down to this purple line a couple more times, and it's going to break, and then you're going to be down into here. And the thing about these algorithms is you tested this at a much lower price, down around 32.30 at the end of July. A break of this here, algorithmically, means that that break is weaker than when price was here. Now, it doesn't mean it's going to come all the way down, but that's how you use these oscillators. It tells you that this is weak and it's got problems. Let's see. All right. So here you have, and this is the scary chart. Let me see. Let's use this version instead. Just a couple of different views. One's a little zoomed a little bit more, but you can see this tight movement between these regression lines, and then it starts to break and it comes back. Now this move that you had on Wednesday, let's talk about the amount of technical damage that did. You just started interacting with this regression line, let's see, two weeks and a day ago. This is the week that just passed. This is the week before, and this is the Friday before that. So about 11 trading days, S&P 500 started interacting with this dashed regression line. 11 days. And it's already starting to lose the connection. And it would have been bad enough if this just came down here and bounced off that tan line. But, I mean, when it came up in here above 33.90 on Wednesday, that was nasty. And that when I mentioned in the beginning that the nasty move down that you had on Wednesday the 19th, that degree, that consequential degree of technical damage is going to need to be reconciled going forward. And this is not reconciling it. It's going to take a whole lot more than a day and a half spike into options expiration. So this whole structure is absolutely a mess. Now, in conclusion, can they take this thing over 3,400? Sure they can. They can take it over 3,400 and start a whole new leg up. But the higher probability outcome is that things start getting rather dicey going forward after options expiration. So, again, you can read the whole report on our website. And if you haven't been to our website, really encourage you to check it out. You can read all the market reports by clicking this menu item. Chart of the day, we post, we try and filter out because we put so many charts out. We try and post the 1 or 2 most interesting charts every day. That's a good thing to check in the end of the day. And the subscriptions, look, I mean, we give you the option of paying for your subscription monthly or bi-weekly. Now, if you do it bi-weekly, it costs a little bit more, but you can try out our service for 2 weeks. No contracts, no commitments. But when you see what our systems do, because all I gave you was a little taste, you will absolutely be blown away because these systems run on the same time cycle mechanics, because it's all about time cycles. These systems run on the exact same time cycles as the institutional algorithms. The only difference is we're not charging you millions of dollars to use them. So you can try out our service for 2 weeks, or if you'd like to save some money, you can choose to be billed monthly. But please check out our website, mercurysignals.com. And again, you can find this whole written report, Do It Again, and to give you an idea how long, this is a really, really long article. It took about 16 hours to put this together, because that includes the chart prep. And I do all of this myself. I do not use a research assistant. I do not use a ghostwriter. I'm adamant about the fact that we're not going to use ghostwriters or research assistants to do this. When you see something put out there from Mercury Time Price Analytics with Mark Anthony's name on it, you are guaranteed it's coming from me and not somebody else. So again, we thank you so much for your time. God bless you. God bless your family. And we hope to see you again soon.